actually said this in front of people that you just need to give your local business owner a hug.
Yeah.
Because it is literally, it is a
hard.
terrifying situation. No, why did I do this to myself? We have a necessity to help people and a necessity to impact someone's life. And we can do that through their financials and through their tax planning and through, I hope people come in and they leave going like,
somebody else has this.
I just feel
Yeah.
better about my whole life. Because honestly, if you can take care of someone's financial picture or like make them feel more at ease about, am I paying the right amount of tax? I think more of your question would be, are credits better than tax deductions?
There we go.
Because you have two different things that you're talking about. The person's mindset towards tax, some people hate it. And they're like, I will put every red cent that I own into not paying $1 of tax for the year.
Yeah.
So their tax goal would be, I don't want to pay tax. Okay. Well, how are we going to keep your money in your pocket?
S Corp.
Well, S Corp could be one way.
Yeah.
We could go buy a pickup truck.
Right.
We could.
Welcome to Spotlight Sioux Falls, where culture meets commerce and the people behind our favorite places get the mic.
We're your hosts, Melissa Goodwin and Steve Schmidt, and we're sitting down with the makers, doers, and dreamers shaping the soul of our city.
From storefronts to side hustles, tattoos to tech startups, we are telling the stories that make Sioux Falls shine.
Because behind every business is a human story, and those stories, they're what make our community feel like home. This is Spotlight Sioux Falls. Welcome to Spotlight Sioux Falls. I'm Melissa Goodwin here with my co-host Steve Schmidt, and today we are at Walsh. Is it tax and accounting? What's the formal name?
Walsh Company, tax, bookkeeping, and consulting.
Walsh and Company. I like it.
Yes.
So we are here with Jim Walsh, and I'm excited because we have an hour to sit here, and I'm going to pepper you with like free tax advice today. So this, I'm excited.
And you guys will definitely be.
Don't say. We are very excited to have you here. We're going to be talking about. We're going to be talking about the big, beautiful bill and all the things we need to know. And we might talk a little bit about golf, too. I hear you're a good golfer.
Used to be.
Used to be. Okay. Well, it's great to meet you, Jim. Tell us a little bit. You know, one of the things that's kind of funny, being a business owner, it's not funny at all. It's actually really hard. It's 80% heartburn and anxiety. Why do you do this? Why did you start Walsh and Company?
It is so funny you said that. At my ribbon cutting, you should have been there. It was funny. I actually said this in front of people that you just need to give your local business owner a hug.
Yeah.
Because it is literally, it is a terrifying situation. No, why did I do this to myself? I did it because I like benefiting the community and I like helping other people. I think that as financial advisors, I don't know that I qualify as like a CFP, you know what I mean? Or that kind of area, but we have a necessity to help people and a necessity to impact someone's life. And we can do that through their financials and through their tax planning and through creating generational wealth for people.
Yeah.
And so we have a unique position, and that's what I like about it.
Yeah. And finance is one of those things. Nobody really likes to talk about it too much. You know, you come into I think it's one of those areas of life.
It's very hush hush.
Very hush hush, just like religion and politics, and like people talk about politics, but finance is one of those things that we don't, we're very secretive about it. And there's probably a lot of shame for some people, or maybe they're, trying to. So it's an interesting area to talk about. And I would imagine there's a lot of trust that's involved there too.
I think so.
Yeah.
I hope so.
And I would imagine that I know when I was younger, I tried doing my own taxes a number of times. Right. And just the amount of like stress that we don't know the codes, you don't know the rules. And so just offloading that to someone else that can help you is such a relief. So I imagine you provide a lot of relief for people too.
I really try to.
Yeah.
I hope so. I hope people come in and they leave going like,
somebody else has this.
I just feel better about my whole life. Because honestly, if you can take care of someone's financial picture or like make them feel more at ease about, am I paying the right amount of tax? Like, or am I doing the right things from a bookkeeping perspective? Am I keeping my receipts? Am I planning for my business? Am I creating something for my kids? Am I benefiting the community? Like those are all things that I think that we do here that benefit people out there. And we like to take that burden off of them.
Yeah. So I would imagine when you were a kid, you weren't dreaming about starting Walsh and Company and spreadsheets and tax codes.
I hated accounting.
Yeah.
So I went to college. I went to college and amazing. I went to college, right? So
you made it through.
I made it through. Somehow I made it, but I have a finance degree.
Okay.
And then I went back to school after about a year and a half. I sold life insurance.
You did? Were you good at it?
I sucked at it.
Oh, well, that's a tough one to sell. That's a big amount of money.
I went door to door.
You did?
Oh, wow.
Life insurance. I made $19,000
all year.
All year. It was great.
Taxes were low, at least.
Taxes were low. Didn't pay any tax. Didn't pay a penny in tax. And I didn't know how to do that. I didn't file for that tax year for many, many years later.
Yeah.
Don't tell anybody that.
Well, there's a lot of things you learn about this stuff, I think, especially as a business owner where you maybe don't know.
With the finance degree, I should have known.
Well, how does finance different than accounting?
Well, I wanted to be a stockbroker. I wanted to go to.
You wanted to go to New York
Boston
and ring the bells
and like ring the bells and like sell stocks.
But instead, you went to North Dakota. It sounds like. Tell us about. You grew up here in Sioux Falls,
man. Yeah,
and then you had a little bit of a stint. You were a golfer on the USF 50-year team. And you're a pretty good golfer from what we understand. I think you shot 5 under the other night at Larchwood till somebody stepped on your balls.
Yeah, that was a bad deal. Yes, I went to USF for 2 years. The Sid Kordemeyer.
Yep.
He was the one that recruited me.
Came
to my house, hung out with us, took me and we had a meal at the Commons at University of Sioux Falls. That was like the extent of their recruitment process, was taking you for a grilled cheese sandwich at the University of Sioux Falls.
And you were like,
I said I was in right there. And I wish if I could have a do-over, I would have like tried to like go somewhere bigger, but
oh, I thought you were going to maybe go for like a roast beef sandwich or something instead.
Heaven forbid. They didn't have roast beef. Are you kidding me? It was like green bean casserole and grilled cheeses. The lunch did improve the second year that I was there.
That's important.
It was important. And then after that, so I spent 2 years there, and then the University of South Dakota went Division I.
Okay.
Danny Sinkson was the coach at the time, and that was a really good move. I learned how to party well. At
Carrie's.
Carrie's was fun. Leo's was fun. Char Bar was great. But more than anything, I learned how to communicate with people really well down in Vermilion. I was the assistant manager at the Ace Hardware.
Oh, cool.
Did that, and they actually wanted me to stay after. But being in that space taught me how to do this.
Cool.
Like really, really, really well. And I can sell really well. I am really good at communicating processes and like things that are really complicated for people.
Yeah.
And like dumbing it down and making it really simple, because what we do is not simple.
We're going to do that today.
We're going to try.
We're going to try and break down. So a couple months ago, right, Melissa, it was a couple months ago, the Big Beautiful Bill came out. And I remember looking at you as my fellow business owner and just kind of going, what does this mean for us?
Yeah.
And I still don't know.
There's so much to this thing. So like we could talk probably for 3-4 days on this thing.
Let's do it. Let's record for 3 days.
I didn't get enough sleep last night.
Do we have enough film time for 3 days?
3 or 4 days. Right, yeah.
The problem is I don't know all the particulars, but I know like the premise of like what everything was supposed to be doing.
Yeah. Let's get into it.
Sure. Where do you want to start?
What is the number one thing that everybody should know if they had to level one thing out and squeeze out of the bill? What is it?
They spent a lot of money.
The government.
The government spent a lot of money
on
to do this thing. Yeah, to do this thing. I think, and do I think it's all great and gravy and stuff? No, but I think there's a lot of things that really are going to impact us.
Okay.
And when I say us, I happen to be a small business owner.
Yep.
And I happen to be a normal person. I'm not like,
I
don't make millions.
You're a normal person.
I'm a normal person. Yeah, it's weird. Except I can golf.
I don't know about that.
I can golf really well. Sometimes, except for the 9th hole at Larchwood. But I think there's a lot of things in the bill that impact the everyday person.
Let's talk about it.
That being some of the extensions and the no taxes on tips things, the no taxes on overtime. Those are going to be big for, I don't want to call them lower income folks, but folks that are average, everyday people.
Yeah. Service
industry, things that they've never had before. And I don't think that you should pay tax on tips.
Right.
Like my personal opinion is that you shouldn't.
Well, no, because then they're going to be 50% instead of 30%.
Yeah. Or the Social Security tax thing.
Yeah.
Like why should I pay into the Social Security Administration my whole life and then get taxed on it when I take it out or when they pay it to me.
Right.
Like, that's unfair.
That's a really good deal for the government.
It's a really good deal for the government. They win on both sides of it.
Yeah.
So not only did they collect it and then put it into this trust fund, because the Social Security and the Medicare taxes they're called trust taxes. And so because you as the employer are withholding them in trust for the employee, and then you remit them to the Social Security Administration. That's why if you're an employer and you're not paying your Social Security taxes for your employees, like, you get in really big trouble.
Yeah.
Like, they'll come knock on your door for that. So you need to be prudent about making those. But, well, why should you be taxed on that? Like,
how often does this change? So we have this big, beautiful bill that is in effect right now, right? Through the end of this year. Like, could it change next year? Like, how often do I have to keep my ear to the rail on all of this
No, this
stuff?
is an administration thing.
Okay.
This will be in effect for a lot of the extensions on the bill will be in effect until 2030. Like, some things will start to phase out. The electric vehicle credits.
Yeah.
The bill gets rid of a lot of the Green New Deal mandates.
Yeah. Yeah.
So the electric vehicles, the wind, the solar, the stuff that we've been taking massive credits on over the last 4 or 5 years, something like that, 4 years for sure. That stuff's phasing out. It doesn't all go away like today, but
like you said, that's an administrative thing where in 5 years they may come back.
It may. It depends on who gets elected in 4 years or 3 years,
Yeah.
We just don't know what that's going to bring.
Yeah.
But it always brings a new challenge.
Yeah.
So that's also why I like being an accountant. There's always something new and it's always changing and it's fast paced and it impacts people.
Yeah.
So there's a few months before December 31st. What do people need to know, or what are some of the top things that we should be paying attention to if we want to take advantage of the changes between now and December 31st? What should we be looking at?
You can't fix things after December 31st.
Right.
So the biggest thing for business owners, even higher income folks, is getting it done before you get to the end of the year. Do we have a need to do tax planning? Do we have a need to get our books in order? Where are we at in that process? Instituting that stuff earlier in the year is it's crucial. You had asked me earlier about R&D credits.
Yeah.
Like, it takes a long time for that process to be done. So the first part would be, do we actually have an R&D credit opportunity? So we have to meet certain stipulations with the IRS. We have to meet the hypothesis test.
What are those? You went through them earlier. I thought it was fascinating.
It has to be your first of all, you have to improve something, right? Like, you have to actually improve your business. Is it measurable? Is it something that actually is tangible? Can we see it? And then
Steve going to stand out in front of the building for 8 hours a day.
It isn't going to be
eat an apple.
Something you can do, right?
But if you're leveraging AI tools in some way to make things faster or more efficient, does that count?
Meet the testing requirement.
Okay.
So are you actually creating the IRS calls it a hypothesis.
Okay.
And are you testing it? And are you actually improving it?
Got it.
So that's the third part to the test. Where I'm actually taking something, I'm improving processes. It's measurable. It's something that we can tell tangibly that we are improving. And then how do we test it? Can we actually measure the improvement? So you had asked me how. Well, measuring and being able to
show,
great, here's our test. If we don't do this, X happens. If we do this, Y happens.
Yep.
So we can actually test that we're making improvements.
Okay.
But what if we don't make an improvement? Does it still
then
count?
There isn't anything that we can do.
But R&D, half of R&D fails, right?
Half of R&D, some of the.
So does it count that we're still testing it?
Yes.
Okay. Okay. Good.
It doesn't have to work.
Okay, that's what I wanted to know.
It has to work all the time, but are you actually working through the process of trying to actively improve your product, your services,
Can I ask why? I love it, by the way. I think it's a great piece of the tax bill, call it.
Yeah.
But why that? Why is that something we can write off as businesses when it qualifies versus all the other things like innovation,
So I think I think your question is like, why
is research and development versus innovation or investing into real
I
estate?
think research and development is innovation.
Okay.
So I think those are one and the same.
Yeah.
I think more of your question would be, are credits better than tax deductions?
There we go.
Because you have two different things that you're talking about.
Mm-hmm.
So like a deduction would be me spending $1,000 on advertising with you guys.
Yep.
It lowers the amount of my income that is taxable.
Mm-hmm.
Okay. It's a deduction for my business. So
From your top
instead
line.
of making 100,000, I make 99.
Yep.
Right. Because I spent $1,000. The tax credit, which would be like the R&D credits, are tax credits.
Mm-hmm.
They are a dollar for dollar offset on the amount of tax that you owe.
Oh, that's a way different.
So
It's
credits
a
are
way different thing. Oh, absolutely.
Yeah.
Yeah.
Okay.
If you can take,
Why did I not know this? I feel so dumb.
nobody does.
Light bulb.
Everybody's like, oh, how does this work?
Let's say it again, because I didn't know that. That's insane.
So credits, just like your child tax credit, right? So
Yep.
let's say I make $100,000. My tax bracket is 22%. Sorry, my fuzzy thing's coming out here. $22,000 is my tax bill.
Yeah.
This is like really like, okay, it might not.
Yeah.
Don't quote me on that.
Yeah.
But I have a $22,000 tax bill. I've got a $2,500 child tax credit.
Okay.
My tax bill
Is reduced.
by $2,500.
Got it. That's a
Because
big
it's
deal.
dollar for
That's
dollar
awesome.
offset. Or I make $100,000. I write off $2,500. Now my taxable income goes down $2,500.
That's not a lot though on your
Not
tax.
a lot,
It's like
right?
6%,
Because
8%.
22% of 2,500
Yeah.
is a big difference.
$80.
2,500 offsetting to 22,000.
Okay.
So that's
So
the primary distinction is between the two.
That's
So not only
great.
there's R&D credits, but there's new employers that set up, I shouldn't say new employers that set up new retirement plans.
Okay.
There's also credits for that. There's Social Security, restaurants that pay tips.
Yep.
There's Social Security credits for the tips that the tax that they pay on the tips for the employees. So that can be a
7%
credit
or whatever that is going to be a credit,
it can be a credit back,
but not a
portion of
tax
it.
deduction, a credit.
It's a credit,
That's a
right?
big deal.
So the owners of the business get to take advantage of the credits.
So it actually helps the owner and the
absolutely.
waiter and waitress.
Absolutely, yeah. Big time.
So you
Big time
so
savings.
the strategy in me is like, how do we get as many credits as possible?
That's just it. And that's the
We're
stuff,
just going to be an R&D company now. That's what we do.
We do. No, but how is
but
that?
that's the stuff that
Yeah.
gets missed. So like if you go to H&R Block and you walk in the door and you own B&G Milky Way
Mhm.
and your
I wish I did.
employees receive tips and stuff, right? Do you think that the average H&R Block guy knows about the some of these
I was a
credits?
proud client of H&R Block in my
probably
20s, and I can tell you probably not.
He's
yeah.
not looking for that stuff.
Right. Seasonal sort of comes in.
Yeah, their specialty is I've got a W-2 and some retirement income and maybe like some stocks or interest income. And like, that's what I do. I push it out the door and then I charge $450 for
Mhm.
a really basic tax return. And that's where we make our money. And
Yep.
that's okay.
Mhm.
They can do that. But from a technical perspective, if you're a business and you're looking for that next level,
Yeah.
that's where we come in. That's where that's stuff that just gets missed.
Yeah.
And then when we look at it, we go, well, why didn't you do this and this and this? And honestly, more often than not, it's like nobody ever told us. We
That's
didn't know about it.
Yeah.
So
It's almost no fault of I'm sure
Absolutely.
you would argue, but like they're busy. Like they're doing tax returns.
they are.
Well, and so that's one of the things, we struggled with early on was like, how do we find someone that can help us guide us
Strategy.
Yeah.
so that we're being smarter about how we run our business? And are there things that we're blind to that we
Yep.
don't know about that we should be taking advantage of? And it feels like that's a most advisory places they don't really provide that. They just do your taxes or they help you do your books.
But you're going to find that happens more often than not.
Why is that? Is it just not competitive enough?
No, I think it's a level of time commitment.
I see.
People too. So like we as accountants we have a 4-month period
Mhm.
where things get crazy.
Right.
Like I mean
December to April.
crazy. And a lot of times we can't charge enough to cover
The craziness.
the craziness. So we try and do it in volume.
Mhm.
And that means mistakes get made because there's too much stuff that we're trying to get done in a short amount of time.
Mhm.
So like if I don't know how else to say that other than people want value for their tax preparation.
Yeah.
And like they're not willing to pay for it. But then you also get that stuff that we just talked about. Hey, I missed this credit. I missed this tax deduction. Well, that's because we had to spend 2 hours less on your tax return, so we couldn't charge you an extra $500 going to your credits. Well, that's the business side of the accounting thing. But that's what we're trying to avoid. That's where I don't want to be. I don't want to be the guy on the street corner that's not taking the time and the energy and the care to make sure that we're taking advantage of all those credits. So
strategically, like Melissa had asked the question, you would prefer to be in that part of the business as well as the retroactive, like the reactive, like end of the year stuff.
Like, yes, we do more of the tax planning thing. So
Got it.
With my clients that come in the door, we walk them through a whole, it's a tax plan. It's comprehensive. So we do the bookkeeping for our clients. And then that walks right into synergies that we can gain for tax.
Sure.
What do we need to do before the end of the year? Do we need to buy a truck? Depending on the type of business that you're in, it also impact what you want to do from a tax planning perspective. Like in your guys' case, one of your biggest things may be R&D credits. The construction space, well, they're not going to have the same innovations, the same things that you're going to have.
Lots of vehicles though.
Well, yeah. They could buy a piece of equipment, stuff that they're going to need. I would ask them to push it off if they can, because they may not need it. They might need it. If they absolutely need it for their business, well, absolutely, you got to buy it. But if you can wait until January 1st, because you're going to need it next year. Yeah. You know, like that's where the planning comes in. That's where the planning comes in. Do we really need it this year? Can we push it off 60 days? That's where we come in.
What about the Airbnb owners and the property owners, or like tell us what's going on that side of the world, or if you've got
weird stuff going on with the Airbnb stuff. Yeah. It's a really weird market. Okay. It's a really weird thing from tax perspective because this is way off Big Beautiful Bill. We're like on cloud 9 right now. We're going to come back. Okay. All right. Yeah. Okay.
Let's float for a minute.
Okay. We're floating. Airbnbs are not passive income. So people don't realize this. Like they get into it and they're like, I bought an Airbnb. Like it's rental, passive income, right? And they're like, it's not passive income though. Right. Airbnb, the IRS regulation says that it is active income. So you're going to pay self-employment taxes on your Airbnb income. It gets reported on a Schedule C rather than a Schedule E. Okay. So Schedule E income is passive income. It's your long-term rental income. Yep. And you don't pay self-employment taxes on rental income. It's not, like when I say self-employment, I mean Social Security, Medicare tax. Yeah. Like that 15.3% FICA. Yep. But Airbnb stuff gets reported on Schedule C.
Or none of that gets paid.
So then, what's that?
The 13% or whatever you're not paying on Schedule C?
You do.
You do.
Yeah. Okay. So like if your business wasn't an S corporation, then you would pay 15.3% on all of the net profits inside the business.
I see.
Does that make sense?
It does. I'm following you a little bit, but let's break it down even more.
All right. Okay.
So, and then we're going to break it down in a way that I think in a way that like, if I'm a business owner, let's talk about the options and then we'll parlay it into the Big Beautiful Bill. What are my options to file? I can be a S corp, I can be an LLC, I can be a entity, joint venture.
Yeah. It depends on what your tax goals are and like what the overall structure of the business is. So
what if I don't know my tax goals?
That's why you meet with a tax planner.
Okay.
Good. That's why you meet with
I don't want to think about that. Yeah.
That's why you meet with someone that's
I didn't even know I was supposed to have tax goals.
More often than not, most people would say the same thing.
I have tax goals now? Okay. Yeah. I like it though. Like, tell me what a tax goal is.
But I don't know. I mean, like that's what
depends.
It depends on who you are. Do you want to? Some people, believe it or not, some people don't mind paying tax. Some people are like, I want to pay my fair share. No, some people are like, I want to pay my fair share.
Contribute, and
like I'm good with that. I think you should pay the right amount of tax.
Right.
Yeah.
I don't think you should pay the wrong amount of tax. So whether that's 10,000 or 20,000 or 30,000, it comes down to how much planning do you want to put into it?
Let's say I'm going to ask
an example of a tax goal though. Like before we move on, like what would?
Well, I think that fits into like what your mindset is on tax.
Yeah.
Okay.
Because tax is a really interesting thing. You could prepare a tax return, and I don't think the actual preparation of the tax return is what influences this, but you could have one person and have 10 different tax outcomes.
Yeah.
And that's because of the planning process. And like, did they go buy a truck? Are we going to fully depreciate the truck? Are we going to extend the depreciation on the truck? Are we going to look into R&D tax credits? Are we going to look into, do they have a child tax credit? I mean, like there's all kinds of things that go into this. The person's mindset towards tax, some people hate it. And they're like, I will put every red cent that I own into not paying $1 of tax for the year.
Yeah.
So their tax goal would be, I don't want to pay tax. Okay. Well, how are we going to keep your money in your pocket?
S corp.
Well, S corp could be one way.
Yeah.
We could go buy a pickup truck.
Right.
We could utilize retirement savings plans to help lower their overall income tax position. HSAs, like there's a lot of things that we can do to lower a person's overall tax liability. It's just a matter of what that person's position is and how much they want to actually put into minimizing or maximizing their tax position, I guess, more or less.
Taxes do feel a little bit, I like what you said about it because taxes to me, when they're retroactive, it's not fun when you get a big bill, but when you're planning for it, that's different. And it doesn't feel like it's coming out of something you don't have. It feels like it's part of your business, part of your plan. You know exactly what you're paying. When you have a client who comes in who says, hey, I'm confused by the big, beautiful bill. I don't know what it means. I've heard about buying commercial real estate. Maybe is that something I can do and depreciate? I've heard about these R&D credits. I've heard about all these things. What is the first thing that you would cover with them when they said, tell me about the big, beautiful bill? Because we're going to go through this because you love golf.
Well, I have to know if it's a new client, first thing would be understanding what their business is and how they do their business.
Okay.
We have to holistically look at their life and figure out where they actually fit into how the big, beautiful bill would actually benefit them.
Okay.
Like there's overall things that are going to benefit the average everyday person. A lot of people aren't hourly anymore. I have a feeling the hourly thing's probably going to go away.
Really?
Hey, no tax on overtime. We don't want that, right? So we're just going to salary somebody and then they're going to have no overtime. So anyway, so that may change. I guess we'll just see what the actual implications of that side of things are going to be. But there's a lot of things inside the big, beautiful bill that if there was a business owner that came in, they've extended the 21% corporate tax rate. They've increased the qualified business income deduction from 20% to 23%, but it doesn't start till next year. So 2026.
Okay.
Which is, do you know what that is?
No.
Okay. So if I'm a business owner and I make $100,000.
Yep. You're going to now take 23% instead of 20?
20. Yeah. So you get an extra 3% deduction on your business income as long as you're a qualifying business. It would be like everybody except for people that make more than like 400,000 or you're in a qualifying space like you're an attorney, stuff like that. That'd be like service offerings.
Got
like
it.
Doctors and stuff also may not qualify for the QBI deduction.
Got it.
But for the average business across the way, like that business deduction is something that you're gonna be able to take.
So it favors the business owner.
Yeah, absolutely.
By 3%.
It favors the business owner by 3%. It's a 20% deduction that they would get anyway.
Yeah.
They just extended it.
That's good.
It was something that was actually set to sunset that is coming back, but they've increased it.
I don't think any business owners would know that.
They had no idea.
So they come to you and you go, hey, by the way, there's now 3%.
And they've increased the standard deduction. That usually is pegged to go up with inflation.
I see.
But the standard deduction be like, okay, if I can't itemize on my tax return, what's the IRS going to, or what is the government going to do for me? Well, they give you a kind of a baseline. You remember when they used to have exemptions and stuff? So you had like 6 kids, you got like, $5,000 a kid, and then you got X amount of exemptions. Well, they don't do that exemption thing anymore. So like when you fill out your W-4, remember how people used to have to put 2, 3, 4, 5 exemptions? That's not how it works anymore.
Really?
Yeah, those forms are totally different.
I didn't know. I guess we've been a company for a while, but those are gone.
Yeah. Now it's when you look at the W-4, it actually, if you have a kid, you put $2,000 on the line.
Oh, interesting.
So they use it as more of like a real time factor for calculating. So like, it's tied to the child tax credit. Okay. So the child tax credit's been $2,000.
Yeah.
And now it's going to go up to $2,500
per child. Is there a max?
No.
So if I had 8 kids, I had an automatic.
Yeah.
22 grand.
Basically. Yeah.
Definitely not no more children. But
I mean, if it saves
if you got
tax money, it might be worth it.
If you got 8 kids,
tax goals.
Go get a G-Wagon and have 8 more kids.
if you like being broke and spending $50,000 a year on childcare, please be like, just have 10 kids. But I tell you what, kids are a really bad investment.
Well, they're not. The ROI is great.
It's horrible.
But for the first 18 years, it's tough.
It's so bad.
Can you just write the whole kid off?
I wish.
No?
I wish. There was some changes to the big beautiful bill as well with I'm not really versed on this, but there was some changes in relation to donations regarding college tuition savings or college savings plans.
The 504, is that what those are called? Yeah.
I haven't looked into how the big beautiful bill relates, but I was reading something on it last week. And so there may be some more advantage for like kids when they go to school.
Bonus deferral. That's been a big topic with people who
you mean depreciation?
Bonus appreciation, pardon me.
Yeah. So if you buy a truck, well, this kind of plays back into what you were asking about the Airbnb thing and like, what can we do? So you can do cost segregation studies on properties. It depends on the Airbnb property that you're like going into or the type of property that you're buying.
Okay.
Most of the time when you see a cost segregation study, you're looking at like, it's a big investment, first of all. It costs a lot of money to have a cost segregation study done.
Like so how much?
Well, that's
for a house that's $500,000. How much would it cost?
It's going to probably be worth it.
Okay.
Like you may be looking at $7,000 to $10,000.
Okay.
Cost segregation study. On a small home like that, it's probably going to be like less just because there's not as much.
Right.
So usually, like if you asked me, I would say $1 million is kind of that. If I'm going to spend $1 million, then I would maybe look at doing cost seg study.
Okay.
Like
because it's the same cost.
Usually it's like a 30% benefit.
Okay.
That's significant.
So yeah. So if I spend $1 million, I make it $300,000 in first year benefit. If you spend $500,000, yeah, 30,000 sounds like a lot. It's
bonus depreciation.
Like, not just bonus, but in like first year benefit.
What does that mean though?
So that's where the accelerated depreciation stuff comes in.
But I still,
like you mentioned,
do you know what this means?
What is accelerated depreciation?
Yeah, we're going to bring it to that.
For the average person who has no idea.
I don't want to say dumb it down.
No,
we're going to bring it.
That's fine. So the IRS has 3 different methods for depreciation, right? Okay. So you can either, so if I buy a truck, for example, a truck is a 5-year life.
Yes.
Meaning that if I spend $100,000 on a truck,
I'm with you.
I get basically 20% a year. Okay.
Can you take it up front? Right.
No, he's going to share.
That's where bonus depreciation comes in.
Got it.
So you can either break it up over 5 years.
Yep.
Or you can take it in year 1.
Yep.
When bonus depreciation was sunsetting over the last couple of years, you could take section 179, which is a different code of the depreciation section of the IRS code, I guess, so to speak. And it has the same rules, but it does not apply. So section 179 is limited because it cannot take business losses below 0. So if I have business income of $1 million and I buy this property and we can write off $2 million of it in the first year.
They're not going to give you $1 million.
Right. So they're not going to give you $1 million. I can only depreciate down to 0 if I use section 179.
Okay. Is that the goal for people?
If I use the bonus depreciation, I can take it below 0. I can take $1 million in losses then.
So what would be an advice?
It's a really interesting thing. And how it plays together with with people's overall tax picture is really incredible. Because like you as a business owner, sorry, I'm gonna come back to you.
Yeah,
I heard you start talking. I'm not ignoring you, but I want to address this.
Totally.
Because there's a big difference between section 179 and what the IRS just did by extending the 100% bonus depreciation.
Okay.
The business owner can write off the truck and take losses to offset their other income.
And if I'm taking losses as a business owner, I'm getting money back?
Well, it offsets your other income.
I see.
So we talk about tax planning. Let's say I make $100,000 in wages for my business too.
Yep.
So the business pays me $100,000 salary.
Yep.
And then I have to also pay tax on whether the business has profit or losses. If the business has a $100,000 loss and I have $100,000 in wages, I could potentially write off all of my taxable income and then I get my credits. Then I get a refund.
Wow.
So how that plays into someone's overall picture is, there's a lot to it. There's a lot of moving pieces, but
most business owners have never heard the word refund.
Refund, yeah.
Yeah, that's a new one.
Yeah, and it plays into what are your overall tax goals?
Yeah.
Do you just want to break even? Do you want to have a refund this year? Do you have where are you going to be? That's where we can come in and say, here's how we get to A, B, or C. What do you think? What do you want to do? And that's where it comes into, here's how much
it's way more comprehensive.
Here's how much
I love it.
No, yeah, it is. And how much do you want to spend to get there? Because it costs us or somebody else if we need to go outside of our own firm to do some of the work. It costs money to do that. And the business owner, the person that's making the decisions, needs to understand that here's how we get there.
So my understanding is you work with, someone who maybe doesn't own a business as well. You have some of those clients.
Oh, lots of them. Yeah.
For people that don't have aren't business owners, what is the number one thing? And, we've heard a lot of things like you should start an LLC. You should do this on the side. Like, what is the number one thing they should be thinking about that they could take advantage of before the end of this year?
There's a lot of bad advice out there.
Yeah. I've heard things that say like, you should start a church. Right. And then you have the
interesting,
like there's a lot of TikTok and Instagram tax advisors that give crazy advice. Right.
Some of the stuff you hear on TikTok is okay. Man, some of the stuff you hear on TikTok is just wild and insane.
Yeah.
There's a few people on TikTok that I do follow that I watch. If you don't have a business and you're just a W-2 employee of somebody else, I think then it's more coaching. You come in and the first thing I'm going to look at is like, what do you have on your W-2? Like, are you funding an HSA? Are you maximizing your retirement savings plan? And then if people are doing those things efficiently, and like because there's only like 5 things you can do if you're a W-2 employee, like to actually like lower your overall tax position.
What are those 5 things?
Well, dependent care benefits, HSAs, retirement savings accounts, pre-tax retirement accounts, or pre-tax like FSAs, things that you can do as an employee because the business funds those accounts for you or provides them for you. So those are what we can do as an employee.
Okay.
You can't do things outside of your employer because the IRS got rid of like the 2% deductions and stuff. A few years ago.
Would you tell someone like you should start an LLC, Bob's Garage, and then you can save money on that?
Depends on what they're doing.
Okay.
It's 10:05 if you didn't know.
Sorry about that.
I definitely didn't start the clock.
We'll edit that out. I'm sorry, guys.
Let
me just shut.
No, you're good. You're fine. Don't worry about it. Once again, it comes down to what that person's doing. Okay. If they have a side business and they're actually operating a business per se, and it's not a hobby. Okay. Because a lot of people come in and they're like, well, I do this. I buy and sell sports cards.
I travel.
Oh yeah, I travel. I like to, but are you doing it for a profit? In order to
what constitutes a hobby from a business?
Are you doing it for profit?
Okay, that's it. Yeah. But I could say I'm doing it for profit. I just haven't made any money.
Sure, you can try that. You can try it. Absolutely. Go ahead.
Okay.
Go ham.
Okay.
Go ham. Do what you want to do. But the premise of operating a business and being able to deduct losses is that you have to be in the business for profit.
Okay.
So you could maybe fail 1 year, but not maybe 5 years in a row.
Yeah, the IRS has rules around that. Yeah. It's hobby losses aren't deductible, stuff like that. So we need to be careful of what we're doing. Some people are like, well, I have a horse farm. I'm like, well, horse farms are a little more like that's really scrutinized with the IRS.
Like a hobby farm.
I'm a golfer. I want to deduct my golfing travel, right? Like that's a really good one for me.
Would they need golf income then?
Yeah, you got to have some kind of income, and I have to be in it for a profit. I mean, I show up to a tournament, and I want to win. Does that count? So there's some level of justification that we have to do, and some common sense things that we just need to apply to like what we're doing before I'm going to say, yes, you're in a business.
Right.
The LLC would be the first thing that I would say. If you're not operating under an LLC, then you're not in business.
Got it.
Like.
No DBAs, no social security numbers.
You don't even know what you're doing. First of all,
right?
You're not a corporation with the state. The state doesn't even recognize you as a business. So in order to be a business, you kind of need to be a business.
Sure.
And so the first step would be forming an LLC, forming a corporation. And then from there, it's, most people are at that point, they're like, okay, I'm actually like doing something that's making money for my family, and not just trying to deduct hundreds of thousands of dollars of losses.
Right.
So yes and no, to answer your question. We want to make sure that if we're going to do that, we're in a business.
Sure.
Setting up an LLC is the reason that you do that is for liability protections.
Mm-hmm.
So are you protecting yourself and your family accordingly? And that's what the LLC is designed to do.
So as we wrap up today, what would be the number one piece of advice you would give to the audience outside of coming to see you?
Yeah.
Which we all should do.
Maybe.
Everybody should call Jim.
Yeah.
But what would be the number one piece of advice? The number one thing you see that people do wrong over and over again, where you're like, oh, I wish they would stop doing this.
They choose the wrong tax preparer.
Well, what does that mean? Yeah.
We fix problems, right?
Mm-hmm.
I mean, Nelson had this sign. So I used to work at Nelson.
You did?
Yeah, I did. I did for a few years. It was great. I learned so much.
Yeah.
Fantastic. I had really great experience. And they actually have on their sign, we fix problems from other tax preparers. Well, we do the same thing. Some of it is just who are you getting your advice from?
Yeah.
And making sure that if you are getting your advice, maybe you should get a second opinion.
If any advice at all.
Even come to me and
yeah.
Go get a second opinion with me. I'm good with it.
Yeah.
I understand what we do. I know the value that we bring. And if you feel like you're missing something, the biggest thing is just go ask somebody else.
Okay.
Go ask another pro. If you're not asking a professional right now, find one.
So it's the strategy, right? Because
Yeah.
I can almost go into anybody and they have to treat me the same because the law is the law and the codes are the codes. But strategically, I can work with you and get advice that's strategic, that differentiates how I'm going to attack that year.
Yeah,
right?
we try and put a tax plan in place. Like I said, we put a really comprehensive plan in place for all of or we try to do that for all of our clients. And a lot of it just has to do with their tax goals. And what's the goal for the year? Are we minimizing tax this year? Are we improving their cash flow for the year? What are some of the goals that the business has for the year?
Mm-hmm.
And if the goal is to stock $1 million in cash into their business, it's probably not advantageous for us to go buy 5 pieces of equipment at the end of the year. That just doesn't meet the business goal. So that also applies.
Mm-hmm.
So we have to be mindful of that as well. And what the business owner is trying to actually accomplish for the year. Do they want to add 10 employees? Well, then we know they're not going to be buying a truck.
Right.
So those are things that we work as an extension of the business owner and helping their team along that process.
Well, he's right outside the old Campbell Supply, right? So when I was a kid growing up, Campbell Supply here, at least that's Melissa said that. And I was like, I know exactly where your office is.
Donovan's has been here for
Next
50 years. So right next door.
Yeah.
You're right next to Donovan's Hobby Shop. Your uncle.
Yes.
It's a family business.
It's a family business. Yeah.
Yeah.
We've
This
been
is
a business
wild.
forever, yeah.
We've learned a lot about you today. Next time we do a podcast with you, I heard we're going to go golfing.
We're going to go golfing. Yeah. We're
over in Larchwood. You're a big deal over there.
We go to the country club too.
Well, that's where your dad used to be the groundsman, right?
Yeah. So let's go do it.
I like it. Melissa, wrap us up.
Oh, okay. Well, I guess one thing that is interesting to me is that people always think that math is a hardcore, you do this and then, 2 + 2 = 4, right? Math is also a language. And it sounds like tax codes are also a language that you can sort of, I guess, there's a lot of interpretations and ways to solve the problem. So I appreciate this discussion today. We learned a lot. Thank you, Jim.
Hopefully I didn't confuse you.
And maybe I could learn a couple things about, golf swings from you too in the future. I'm looking forward to that.
I would love to do that.
All right.
One thing we didn't talk about, we'll talk about next time, is buying commercial real estate, because that's on everybody's mind right now because it's talked about a little bit.
It's expensive.
It's really
expensive right now.
We could probably do a whole episode about it.
Definitely,
I've seen a lot of Instagram and TikTok stuff about do this, buy a bunch of land, call me and I'll set you up.
The big, beautiful, speaking of that, the people are going to start doing this again. So remember the the qualified opportunity funds a few years ago? You didn't hear about those?
I maybe did.
The government incentivized businesses. Sorry, you're trying to wrap up. I'm trying to
We'll get there. We'll get there.
The lower income parts of town.
Yep.
Have you seen over the last 5 years where they're trying to improve it?
Yeah.
And you see them leveling buildings and stuff. A lot of that had to do with opportunity funds. The government brought that back.
Okay.
So we're going to start seeing people do that again. So
to improve communities,
the railroad and stuff.
Yeah.
To get rid of the old stuff and bring the new in. bring new money into old parts of town. So downtown started getting renovated. A lot of that has to do with qualified opportunity funds and and bringing new money into those areas because the buildings have been so dilapidated and there was no incentive for people to actually like buy in. But there's a lot of the qualified opportunity zones. The government provides a lot of incentive for people
as a business owner.
Yeah. Oh yeah, absolutely.
So if you move in one of those,
absolutely,
those are a good idea to move into.
Yes. There's
tax credits.
There's a lot of tax credits involved. Yes. There's historical rehab credits involved. So, I mean, yes, there's a lot of incentive for people to start looking back into that over the 2026 and beyond. So
they can call you and get all the advice they would want. This has been, it's like a mathematician. Next time we're going to get a whiteboard because when we bring it down to a very basic level, I think it's still taxes and finances, like Melissa said. It's always a little bit of, it's kind of over most people's head and we don't want to think about it because it's usually not great when we're not planning it, you know?
Yeah, it doesn't have to be bad though. If you plan, go. Right? I think that's the gist of the conversation today. So thank you, Jim.
Thank you.
Thanks for giving us all free advice for the day. And we'll be back.
We'll see you next episode on Spotlight Sioux Falls. I'm Steve Schmidt. We got Jim Walsh and
Melissa Goodwin. Be sure to subscribe if this was helpful or if there's someone that you felt like may benefit from this information, make sure to share the episode or share some of the shorts. And we'll see you next time.
Thanks for listening to Spotlight Sioux Falls.
These are the stories and the businesses that shape our city. If you heard something today that made you smile, made you think, or maybe reminded you of someone you know in your neighborhood, please share it.
That's how we support local. That's how we grow. And if you know a business owner we should feature, or if you want to tell your story, reach out.
Until next time, we're Steve and Melissa, and this is Spotlight Sioux Falls, where local stories get the stage they deserve.